Right now we're looking at some clients invest in Uber. Fascinating company, and to look at a company that has so many issues. They're in all these markets. They've been fairly headstrong in how they've entered some markets, and it's caused some regulatory backlash in some jurisdictions. It's caused outright lawsuits in other jurisdictions. How they treat their employees or their contract drivers is another point of contention that really could have an impact on the ultimate cash flows of that business. You end up having a lot of moving factors that who knows how that'll play out. Any one jurisdiction, how Uber is accepted and regulated in India could be very different than it is in the US. Both of those are meaningful markets to them. It could really have a big change on value. That's difficult to think about how that's going to happen. You can look at their forecasts. Their forecasts are amazing, and you see the amount of money they look to spend on CapEx in 5 years. It's astounding. It's in the billions of dollars. How does a company that makes an app spend $1 billion or more dollars on capital expenditures? It's clearly not to change the color of the app, the text on the app. They're doing something. There's an article, I forgot what it was in. I think I read it yesterday. I've lost track of days, so I apologize. Jet lag can be tough. But it was in the past day or two about Uber and how they, sorry, I lost my train of thought. Yeah, sorry, I'll come back to it if I think of it. But there's a lot of moving parts there. And, how will it all play out? It's hard to tell. But again, we see transactions, we see these forecasts. Will they ultimately get self-driving cars? I think that's part of the topic I was thinking of. That'll change the market a lot. There's a lot of talk in I'd say maybe I'm more familiar with, at least in the US and Europe, about inequality. Well, if you take all of a sudden all the transportation workers that are driving taxis and buses, and you make them unemployed because there's no cars, it's an interesting issue, and despite the fact that you can do it, should they do it, or will they be allowed to do it? Who knows? It'll be interesting to see. Thinking about early stage investments and how we see clients valuing it. Luckily for me, I don't have to necessarily be the guy who sets a price and pays it. Early stage valuations are definitely difficult. When we look at a client's investments, what we often want to do is understand what they were thinking the day they made the investment. What was the thesis? What did they see as the opportunity? What did they see as the risks? What did they see as the milestones and the timelines around things? Are there regulatory hurdles? Are there technological hurdles? Regulatory hurdles can be much less predictable. I know I've worked with a couple technology firms where largely their motto is, when it comes to just technology, largely the impossible just costs more and takes longer. It's not an if, it's just a when and how much. So as you go forward, once you get a good idea of what the investor was thinking when they bought the investment, what their expectations were going forward, you can look at the valuation date or the inception date of the investment, benchmark it to, if nothing else, just an industry index. Even if you create your own index of some publicly traded comps that you think are remotely similar to the company, in high-tech companies or startup companies, they're often very unique. They're in a very small niche that just doesn't exist. Uber is a good example. There were no car-hailing apps 2 years ago. Now there are. Maybe it was 3 years ago. I confess I don't have it on my phone. But what did the world look like at that inception date? So that when you go forward, be it 3 months or 3 years, how is that investment performing versus what was expected? If certain regulatory approvals were assumed to be happening at the investment date 12 months out, and you're now 24 months out and those haven't happened, what does that mean to value? All else equal, it probably isn't good. If technology has been a challenge or something has been difficult to do and it's now taking longer, is that detrimental to value? Or through the developments for how things have changed, maybe they delayed the development and the launch of the product because something new had to be added to it to make it better. And by doing that, they've expanded the market by 10x. And it may actually have increased value. How are these things really impacting value? What happened to the overall market? You know, if the market's largely been flat since the inception date, you at least have one data point that says maybe if all else is equal, the investment may be, you know, still worth the same thing. But if the investment's down, you know, 500% or up 500% in that period, it can't be down 500%, but 1/5 of what it was. You know, you probably have it'd probably be very difficult to say that the rising tide doesn't, you know, raise all ships, or the falling tide doesn't, you know, sink all ships. And another data point that you need to consider, it doesn't mean that it impacts the company, but it's something that you need to think about, you need to explain, you need to document. Another important thing that we think about in early stage investments is when you made the investment, did you expect another round of financing to be made? If you expected another round of financing, and there is another round of financing, largely it was expected, it may not be the exact same size, but by and large, that's not going to mean there's a significant dilution event that you didn't anticipate that you should have. If you didn't anticipate a new round of financing at the onset, and to us it's a very important thing for us to document and understand, and then there is a new need for a round of financing because cash flows aren't there or something else has come up or expenses have been higher, that probably means you're going to be diluted, and that's not good for value, and that's going to push the value down. So when we look at all of these factors, you know, whether it's the operations, whether it's milestones, you know, rounds of financing, dilution, overall market performance, we take all of those factors, we weigh them, and we say which of these are the most important factors, you know, that would impact this company's valuation. You know, how does it change the outlook for the company? And ultimately take that mosaic and develop a good picture that says, is it up, is it down? And then you start to get into, you know, the much more subjective art of, well, how much? And that's difficult. Partly, you know, what we would look at is we're going to look at whatever information we can look at from the inception date to see what things did people think about. You know, in the last .com bubble, it was how many eyeballs were people looking at? Well, did the eyeballs go up and by how much? And it may be subjective, it may not be the best measure, but maybe that's what should have been used. Come up with something that you think is reasonable, and spell out your thought process and document it. You know, I think what we see, we have many clients that, you know, we look at 6,000 investments a quarter. That's a lot. We have clients that are incredibly thoughtful about their valuations, and it's very clear that they sit around the conference room table, they talk a lot about these same issues, and they come to a conclusion of value, and they write down the conclusion of value and nothing else. When a regulator comes into their office and says, show us what you've done, one number doesn't really fly with the regulators anymore. You have to show what you did, show why you did it, and have a consistent process over time. And so documentation is very important. You know, I was never a big fan of, you know, essay questions in college. I was never a fan of big term papers, but the reality is, in real life, documentation is important, at least in this little corner of our world. And writing things down really does help. And yeah.
No, sorry, I just had a question. Like, you know, for a lot of the reasons that you have just outlined, and a lot of us believe that valuation is, especially for early stage companies and growth companies, valuation is what a buyer is happy to pay and what a seller is happy to sell it, right? Mm-hmm. So, and valuation is, like, you know, based on so many different assumptions for this kind of companies. So do you think a lot of this valuation work is done purely for a documentation or a regulatory perspective, rather than to base your buying or selling decision on?
So the question is, you know, basically what are people using these valuations for? Is it for just purely documentation purposes? or is there something else? You're 100% correct that the concept around fair value, at least under US GAAP and under IFRS, is what a market participant would pay at the measurement date without being compelled to sell in a disorderly manner. So an orderly transaction with an appropriate marketing time and assumed and all that. The reality is that if you're looking at, say, a venture fund or private equity fund that's closed end, at any interim date, it's a reporting exercise, and it's a reporting exercise potentially for regulators, but definitely for LPs. The LP community has changed. If you go back definitely 10 years, maybe even 5 years, and I apologize if I touch a nerve here, but the bulk of people that worked at in the LP community were municipal employees, and government employees. They were not necessarily classically trained financial analysts. That they went to work for the government and they found themselves better at something than somebody else was, and they got put into a role to do something that, making investment decisions to put money into a fund. The reality is today, the LPs are infinitely more sophisticated than they were 5 or 10 years ago. The systems that they have to operate and work with are much, much better. It was only probably 3 years ago, I went down to a very large city pension, and the head investment guy there had his desk covered with LP reports. That sort of classic movie, the analyst kind of peeking between all of his stuff to talk to you. His job for the day was trying to figure out what their allocation was to the retail sector, and he's literally going report by report by report trying to figure out how much they have in retail. Today, more and more of the investment professionals at the LPs are actually classically trained investment professionals. Many have worked at funds, worked at banks, or as investment bankers, and understand finance very well. And they also understand that they don't necessarily want to be compensated like an hourly municipal employee. That more and more of their compensation is based on performance. And so if they invest in a portfolio of funds, which ultimately are investing in a portfolio of assets, if those assets are all held at cost, the performance of their portfolio doesn't look so good, and they don't get paid. And if they don't get paid, they end up somewhere else, voluntarily or not. So increasingly, it matters because the LPs are actually using it to make decisions, to measure their investment decisions, what were good investments, which were not good investments. The secondary market for LP interests in 2007 was a purely distressed market, that very few people were going there to reallocate their LP portfolios. Now it's something that LPs are using very regularly to buy and sell 1 or 2 interests here and there, never mind large portfolios, to rebalance their portfolios. So understanding fair value is becoming increasingly important as LPs are really managing their portfolios. I haven't seen very many articles worldwide of pensions that are overfunded. The vast majority are underfunded and really are becoming much more active in managing their portfolios. There's not a lot of yield in the markets right now, so equities, including alternative assets, are getting larger and larger allocations, and therefore they have to be able to measure these and understand what they've got in their portfolios better. So is that helpful?